good morning to you, of course.
Good morning or good afternoon to you as well, Del.
Yeah, good evening, as you can see from or maybe you can't, the darkness outside in London. So yeah, for everybody else's benefit, Matthew is managing partner of Leeward Capital and is a regular speaker on intangible asset strategy and finance, and has his own business, Leeward, which we'll talk about today. Matthew's also really a very old friend, or as old as could be for such a young company, to Intanify. Matthew gave us a lot of insights and inputs, really, as we built the concept for the business, but then also raised the capital. So really value the relationship we have with Matthew. So Matthew, you founded Leeward really to solve your own problem. So I thought maybe that would be a good place to start to hear that founding story.
Yeah, no, I'm happy to start there. If you told me 5 years ago that I would end up being arguably a subject matter expert on intangible asset finance, I would have looked at you cross-eyed. I would not have guessed that this is where my path had taken me. I ran a family business, arguably an old economy business in the building product space, but I spent the better part of a decade converting that business from being an old economy wholesaler into being a tech-enabled logistics business, where the technology was indispensable to what we did. In pursuing a tax strategy for our family enterprise, I carved those assets out and put them into a special purpose vehicle, and those assets being the ERP system and all the tangential technologies that were baked around it. The kind of assets that have no value generally on your balance sheet, either because they were expensed or fully depreciated. But for most businesses in the modern service economy, you're indispensable. Certainly that was true for even my asset moderate to asset heavy industrial manufacturing and distribution business. So I carved those intangible assets out, again, our technology and data, and I put them into a special purpose vehicle for tax. Related to our family enterprise. And after I did that, I said, wait a second, these intangible assets, again, even though they have no value on the balance sheet, they really are contributing to the enterprise value of my business and other businesses. What would a financing strategy look like around those intangible assets? And that's what took me down this rabbit hole of intangible asset finance. And in the process, I had to understand the other products and how this product fit into the broader, not only intangible asset finance space, but in the broader capital markets. So that's the background. And Leeward was founded based on the structure I created for my family business. And it's been a real learning curve and a challenge creating something new, but has my passion and high conviction.
Yeah, and I mean, your business really is a microcosm, American Forest Products, a microcosm of the whole economy, really. So obviously we think of FANGs because of how dominant they are on the S&P 500, but every type of company is 80, 70, 90% intangible assets. So that kind of really led you to the thesis, and maybe you could just share what the thesis is from a more macro kind of perspective.
Sure. The Leeward thesis is predicated on looking for businesses that had the same characteristics my business had, which is they had some sort of, I'm not going to call them, it's IP, but it's not your traditional IP in the form of copyrights, trademarks, patents, not the legally protected stuff, not formal IP. That would be the more proper designation. This is businesses with informal IP, trade secrets, know-how that sits on a server somewhere. Again, generally has no value on the balance sheet. So I look for businesses that have those types of assets. One of the ways that I help qualify that, particularly when I'm talking with an operator who says to me, oh, I'm not a software business. I'm not a fit for you, Matt. In fact, that's actually not what I'm looking for. I'm looking for lower middle market businesses that are profitably performing, but have these types of intangible assets they rely on. And I use the theoretical notion of ransomware as a way to articulate what Leeward means by mission critical technology data. Because everybody kind of understands that, broadly speaking. They know what, generally, even if they've not experienced it, they know what a ransomware attack looks like just by reading the newspaper. And effectively, if a company were to be crippled by having ransomware both on their primary instance and their disaster recovery, then even though those assets generally have no value on the balance sheet, if the company can't operate without them, then they're contributing to enterprise value. And that's generally when the operator or bank or whoever it is I'm talking to has that aha moment and says, okay, now I understand what you mean by these assets having value to the business. And they oftentimes may have value outside of the business too, but really I'm focused on their utility and use for that particular enterprise. And you have to be cautious too, because when I say ransomware, sometimes folks think it's a gotcha question, that I'm testing them on their disaster recovery, and I'm not. It's designed to help people understand what Leeward means by mission critical technology and data, and ransomware makes for a convenient framework.
Yeah, it's really interesting and a funny analogy, really, because we founded Intanify because of answering a question already with a friend of mine saying, why is my technology not an asset? And I was like, well, it's a bit of a funny thing, but it's not an asset because the accountants say it's not an asset. He's like, well, that's ridiculous. Why is that the case? And I'm like, well, for an accountant to say it's an asset, it's got to, you got to be able to kick it. There's got to be a serial number you can write down. You've got to be able to reconcile it against, some kind of report somewhere, and then it's an asset. But even if it produces cash flow and it forms the bedrock of your competitive position, doesn't necessarily make it an asset according to the accountants. So it's funny to have to explain it to that way, to say, you think it's got no value, but what happens if it's gone? And then, the aha moments, well, then our business doesn't work. So obviously there was value there.
Yeah, and you bring up a good point in that, there's two angles to this. There is that accounting methodology has not kept up with the sources of innovation and sources of value in the modern economy. Right? Then what did it cost you to implement it? We're going to value it that way, right? Well, that doesn't take into consideration the hours and know-how and iterations it took over years to actually construct that. And that cost basis just looks like, what did you pay for the software licenses and the implementation of the technology in the first place? So that is an incomplete look at the assets. So you have this challenge being at the forefront of intellectual property and intangible asset finance, more specifically, that the accounting rules don't offer a good roadmap by and large, and in some cases can be a challenge. In the case of Leeward, and I think in the case of other types of intangible asset finance, in order to substantiate the transaction, you need an appraisal. Well, what method? If the appraisal methodologies are taken from the accounting methodologies, which haven't kept up with the sources of value, really hamstrung. And so it took us a number of, I would say, a year to devise a valuation methodology that was tried and tested, but that also worked for our thesis. And I think that is one of the problems and one of the challenges that other folks who are looking to monetize in one form or another these types of intangibles, they got to figure that stuff out, depending on the nature of their transaction structure. And I could describe it to you in 90 seconds, but it took me a year to figure out, which was part of the evolution of the intellectual property around how Leeward delivers its capital.
Yeah. Tell us. We've got a couple of methods that we use, but I know yours is a little bit different to the three really standard ones. Is that right?
It is a little bit different, Dylan, and that would fall into the category of a trade secret for Leeward.
Okay. So it's not the one on the deck.
Not the one not the one that I want to broadcast broadly.
Okay, cool. Sorry.
If folks have an interest and they pick up the phone and want to talk to me like you did, I'm quite transparent. But I want to know who I was talking to first before I describe it.
Sorry. I thought I was asking a question straight from the deck. Okay, cool. So, right, let's see. What types of intangible financing have you seen? You said you had to kind of place the structure that you had developed within a spectrum. So what are some of the other ones before we zoom in on service?
So most of them exist around. Most of them risk around formal IP, right? Stuff that has been legally protected. There's the most documentation around that. It's the most there's the most robust capital surrounding those assets. So IP sale license backs, IP-backed loans, royalty finance, even though that's not entirely around the IP itself, or it may not be around the IP itself, it might be. It still fits into that intangible asset finance category, in my opinion, because the businesses that merit royalty finance straight off their revenue oftentimes have these types of intangibles, whether they're protected or not. One of the areas that I find particularly interesting, and I think is an important element to bringing more capital to bear, I'd love to try to figure out how I can utilize this tool in my business too, and that is the notion of collateral enhancement insurance. So basically, you have your IP, could be a trade secret, although a little bit harder and to value, but you go and get an insurance policy that is a backstop for the value of these intangibles, this IP. You have that insurance policy that is attached to the IP, and you go to a lender. You say, listen, will you lend to me, lend it to our business? Might be a cash flow loan, might be IP loan, but it's a loan to the business. But there is this insurance policy that backstops the value of the IP in the event that the business is no longer around. And that insurance can bring down the risk for a lender and thereby bring down the cost of financing. If the risk is lower, the cost of the capital, which allows businesses with it otherwise might not qualify for certainly a traditional asset-backed loan, or even a cash flow loan because they might be early stage, access to affordable capital that doesn't require them to give up 90% of their business to go execute on their growth plan. So that's one of the areas I see a lot of those. And while that's not what Leeward does, I spend a fair amount of time helping people who have those types of businesses find the right source of capital, of which there are an increasing number of folks.
Yeah, Aon being one of the big examples, right?
Yeah, and as luck would have it, one of my best friends from graduate school, he ended up being the head of AIG's intangible asset finance strategy. I don't know his exact title, but he oversees a lot of the underwriting that they do for these types of policies, because AIG is one of the largest insurers for IP, yeah. And so it came full circle through personal relationships with somebody that ended up in a tangential part of the broader intangible asset finance space. So yeah, Aon is the leader and has a lot of thought leadership around these policies.
Yeah, they've also got the IP Solutions Group, which I think does a lot of the consulting. So yeah,
and online too. So they help the consulting piece, they do the broker piece on the insurance, but they also have a pocket of capital to take advantage of this. Not in small part because it was like a lot of parts of the intangible asset finance universe. There's not enough capital for all the businesses that would otherwise qualify, and so they saw an opportunity to participate in that space too. At least that's my interpretation.
Yeah, I mean, it's such a curiosity, isn't it, that if intangible assets now like 90% of EV, 80-90% of EV, and so I mean, this is $60 trillion of assets, 80-90% of them are these assets, how there can be almost negligible capital against it. Any thoughts or reflections to why that's the case, or it's just still got to happen?
I remember, I'm going to tell an anecdote about when I was trying to find the right source of capital. See, leeward structure is similar to a sale leaseback or an operating lease, but those are more common in hard assets and real estate and equipment. So I remember sitting across the table from a fund that did sale leasebacks, real estate sale leaseback, and he understood fundamentally the structure, being a sale leaseback person, but he said, well, what are these assets worth if we were to, if the business were to go away? And I said, well, a lot of the businesses are going to have IP that has some value, but it's complicated. It's hard to know. It would require a fair amount of work to monetize those assets, those intangible assets, unlike a piece of real estate, which you can just turn around and sell. And you just could see that the light turn on, like, okay, I don't know. If there's no residual value that I can point to and monetize really easily, I'm out. And I think that is true of a lot of lenders, not just folks who are interested in lending to through sale leaseback strategies, but cash flow lending too, right? Like it is, and the other piece that I would refer back to is that story around analogy to grants. Like if it would, the reason I was able, people ask me, why were you able to come up with this that others have not, right? This is really elegant, Matt, or really interesting, or I haven't seen this before. I love that feedback. The question was, well, why hasn't anybody else done it? Well, one, it was hard creating something new. But two, I think you kind of had to have operated a business with these types of assets to understand their importance and the intersection of those intangible assets to the operations of the company. And I think my operating background helped bring some context to this that allowed me to conceive of it, and the desire to want to push through a lot of barriers to solve problems, to create a product that would stand up to scrutiny, both from a credit and tax perspective. So to come back to your question, I think you need a broader toolbox of different skill sets, maybe having been through different industries or different roles, to be able to execute on some of this stuff that is just not easily come by. Right? That would be one of the conclusions that I would reach, is that it takes a broader toolbox to kind of put all these pieces above together, because you're building something in a lot of ways that's never been built before. And the other thing that I would say is that at some point, folks they don't want complexity. Like, just please keep it simple. But the simple stuff is not where a lot of the value creation is. And trying to find that right mix of simplicity with value creation in that sweet spot is really challenging.
Yeah, it's and it's interesting you said, as an operator, really understanding these assets, because, and this probably wouldn't have been helped by the accountants either. I mean, having never allowed these to be recognized as assets, because I think what we see at Intanify is people intuitively know that they're assets, but it's very difficult. And even part of the work we had to do was to build our own proprietary taxonomy, because it's not easy to fit these into buckets. And with these, actually, even when you do fit in a bucket, it might actually also fit in another bucket as well. And because all of that, it does feel a little bit complicated. But finance has figured out much more complicated things, and also, frankly, a lot more risky things. So I think it would be ideal to have a piece of land that was in collateral, that was valued, and on the main shopping street. That's the best case. But think of all the subprime loans and all kinds of CDO squareds and all these types of things. Incredibly complicated, not very good collateral. I would argue that there's a lot of intangible assets are probably kind of higher collateral value. And anyway, those markets ended up in the trillions of dollars. So I do think we get there. I think there just needs to be a broader understanding and maybe a common language, which will come.
I would make a distinction between financial engineering around a known asset class.
Yeah.
The big banks are really good at that, right? And layers of the layers of bifurcating risk and capital around a known asset class.
Yeah.
Versus an asset class that you kind of intuitively know has value, but is different. And I would make a big distinction too between formal IP, right? Stuff that you can look to the legal documents that are protecting it, and methodologies for valuing formal IP that are more robust, versus informal IP, which is a broad category for trade secrets know-how, whether it sits on a server or not. And how that's a much harder asset class. You intuitively know that there's value there, right? But how do you describe it? And not only how do you describe it from an accounting perspective, but how do you describe it from a credit perspective to a capital market space that folks who are in the capital market space that really know the existing verticals and how to engineer around the existing asset classes versus creating a new one.
Yeah, fair point. Then I guess I would probably point to things like, I don't know, cocoa bonds, hurricane insurance, these types of things, which is also underlying, weather bonds, underlying pretty complicated stuff that's, is ethereal as others. But it's
a big one too, right? Data is it's illegally protected in that you can't necessarily own somebody's personal identification information, but you can own the rights to create value from it. And I think data is one of those areas where it's not a formal IP, you're not copyright or trademarking it, but it is an asset. You know, and utilizing it. I remember seeing an example of a company, I can't remember the name, but they were helping airlines with the data around their frequent flyer data, like people, their thing, and there was this trove of information that allowed them to monetize that and create income streams from it that made the asset a piece of collateral they could borrow against. It was fascinating. I thought it was really interesting. And I think that data may be one of those areas that sits somewhere in between the formal IP, that is not a formal IP asset, but people can point to and understand better the value of those assets than say something that gives a system or a process. And by the way, we can monetize data too through our sale-to-service structure. We can include that. So it can be a asset moderate business a technology light business from a system standpoint, where the systems may be, not entirely, the company doesn't entirely rely on the systems. They get replaced with something else, but they couldn't replace their data. And we would come into those businesses too, because we see value in it.
Yeah, that is an interesting one. I was looking at just the other day, and there's over 200 data exchanges now where you can actually sell your data. Clearly not personal data, but data on testing and data accumulated through machine learning, iterations and those types of things. But yeah, so why don't you tell us and explain a little bit more detail about the sales to service? Because I mean, it's super cool. I'm a big fan, and most people wouldn't know. So yeah, why don't you give us a 101?
Thank you for that. Yeah, and this sale to service strategy, I think, should be just one of many innovations around monetizing informal IP. And my expertise was around the systems with my operating background, but there's got to be a lot of folks out there that have expertise on other types of human capital, other types of know-how that could merit other types of structures to monetize that value. So I'm just one of many, hopefully, that will evolve in time. I created the term sale to service because I wanted to distinguish it from a sale leaseback or an operating lease. I wanted a product that was unique to Leeward. So I trademarked that. The structure resembles a sale leaseback, meaning that we're buying an asset and then delivering that asset back to the seller for their continuing use. So operation for the customer in this case, it's not a borrower, it's a customer. Operation, they're not impacted. But effectively go through our valuation exercise. We look at the business through two lenses, right? There's the credit lens, which is this good business going to be around to pay these fees? That's not unlike a traditional credit box and get out of a traditional cash flow lending. And then the second lens, which is, are these assets mission critical? We use the analogy of ransomware earlier, so we apply that lens to it. It's not as hard as you think. It's kind of black and white. There's not a whole lot of gray area, and to the extent that we find a business where there is gray area, it's just facts. So are they indispensable, mission critical? And then we use our valuation methodology to come up with what we believe those assets are worth to the business, and we buy those assets for that amount. That money comes into the business for their own purposes, whether it's a liquidity event or a shareholder event or a buyout. One of the inefficiencies of my product, and this will be true of other sale leaseback strategy or similar sale leaseback strategies, that's true in all types of IP, is that if you buy the asset, if you're truly taking title to it, which we do, like an IP sale license back, you're buying an asset for a lot and they have value that's very little on the balance sheet, again, because of our accounting methodologies. So that creates a capital gain event. And that capital gain event makes me less efficient for growth capital for debt repayments. And so I have to focus on deals where somebody's largely paying cap gains anyways. That's actually, when you look at my deal funnel, that's the most narrow part of my funnel in terms of the use of proceeds, because the number of businesses that fit the credit profile and the mission critical technology and data profile is the entire modern service economy. Yeah. And so the use of proceeds tends to be where I spend most of my time trying to narrow the funnel and that. So there's a capital gain inherent there, and that will be true of other sale leaseback strategies. And the sale leaseback strategy is is, as opposed to a loan, if you lend against an intangible and the business goes away, you have the risk of being crammed down to the replacement cost of that intangible. Whereas if you physically do a sale leaseback and you physically control it, there are some other credit tools available to you. But now there's no third party that's going to cram you down in terms of your loan value. You physically own the asset. You're at liberty to do what you need to do to create value from it. And so that has a meaningfully better risk profile than does a loan against intangibles, unless the intangible, the IP is broadly known, or whether they maybe have an insurance policy like we described earlier that offers facts.
Yeah.
So a little bit tangential, but important for people to understand as they're conceiving of these types of monetizations. The structure you use has consequences that I didn't contemplate when I first started this, and I was a year into it before I realized, holy cow, there's this big capital gain event that just narrowed my phone. So I had to be more specific in terms of where I was, what types of transactions I was marketing through. Okay.
Yeah.
So we buy the asset, there's a capital gain that's inefficient. So the use of proceeds matters. And then the company enters into, in our case, a services contract, because that fits what the nature of the assets are, right? Much like a software as a service contract, that is the assets. It's not a lease, it's not a license, we're delivering a service. And that has some trade-offs structurally in terms of the nature of the agreement that we enter into, that both have tax as well as bankruptcy considerations. But that was the ideal structure for us in this asset class. We enter into a services contract. It lasts 3, 4, 5, 6 years. And it's powerful because it's the cash flows coming from the business are all of them. It is a tax efficient solution for borrowing. Now, we consume a fair amount of free cash flow. So it's not a great fit for businesses. They need a lot of free cash flows to grow. There's other ways to solve for that, but it's one of the negatives is that because we're a services contract and we have a definitive life, we need to get back our return during that window of time. And so it's a deductible item, which is foundational for our value proposition. That's fundamentally what it is. There's some stuff on the back end. The company has the ability to buy back the asset at a fair market value. That's generally unknowable at the front end, at least directionally. And or they can abandon it. They can go on their way. That's the ability to monetize these if they abandon the assets. That's not likely to happen very often, but it could. And again, our models are designed to account for that. That's functionally what it is around tangibles. Was there any other questions you had in that regard?
Yeah, of course. So maybe just to recap, if I'm a company, I'm worth say $50 million. I've got what I believe is $10 million worth of intangible assets that are incredibly important to my business. I couldn't really operate without them, but I need to raise capital because I need $10 million to grow to $100 million valuation. And rather than going to the equity markets or other alternatives, I have a conversation with Leeward Capital. I disclose my information. You confirm that it's worth 10 million, or maybe you say it's worth 8 million, or maybe indeed you say it's worth 12 million.
It could be more, yeah. And I would guess with our methodology, it very likely is more than what you think it is using our valuation methodology.
Okay, cool. So I think it's worth 10. You told me it's worth 15. Great news. I transfer in the transaction ownership of those assets to Leeward. Leeward lends me or transfers to me $50 million. I then pay a service fee over, call it 3 years, which looks like a lease payment.
Probably longer, but yeah, it could be 3 years.
Okay. 3 years, 5 years, which is kind of like renting my asset back. And then after about 5 years, I have the option to buy back my asset for what might not be $15 million anymore because I paid some of that capital off. So say it's like $12 million. I then own the asset that I originally owned. I've repaid the capital. And in the meantime, I've been able to use that $15 million in place of equity to grow my business or to buy up minorities or any of those types of things. So that's correct to understand? Yeah, okay.
The repurchase is going to be meaningfully lower than the original transaction price because the the assets may diminish over time in terms of their value. They do have liquidation value, and so it's not a bargain purchase by any means. There is a fair market evaluation, but the repurchase price is generally during the life of that structure. These assets may have aged, they may have become less valuable to you. You may be able to move to other assets. So it's generally a lower purchase price. And so anticipating that and knowing that we very well may end up with a fair market value meaningfully lower at the end than we started with, not zero, but not 15. We push the bulk of our economics of our deal into the service payments, which makes them deductible. And that's the tax benefit. In addition to the fact that, people don't do this deal just because it's tax efficient. It's non-dilutive. It recognizes value, which may not. It has a lot of other implications. Oh, here's another aha moment. This was a surprise to me because I was focused on how do you find value in these intangibles and make a structure that is also creditworthy that can track out things. But I was dealing with a for-profit education school, which are challenges from there's a lot of regulation, particularly ones that get Title IV funding here in the United States from the Department of Education. They have rules around leverage and in order to qualify for Title IV. And the advisor asked me, hey, is this thing on the balance sheet? I don't know. I never thought to ask. I know it's a services contract for tax, but I don't know how the GAAP treatment works. And so we ran up the flagpole with the quality assurance folks in SICKITCH, who have a special expertise around for-profit education. They came back and said, yeah, this thing's off balance sheet. It's a services contract. It doesn't sit on the balance sheet for GAAP. It's going to be in footnotes. And that was a real aha moment because it's while most people won't care whether it's on the balance sheet or not, it's an obligation. And they have the risk of losing those assets if they default on the payment. Likewise, I have a risk of not getting paid if I don't maintain the services contract. They have to have access to it. So there's risk going both ways there. But for a very small group of folks where balance sheet debt works against them, whether from a regulatory standpoint or what have you, there's a whole variety of reasons why folks may not want something on the balance sheet. This is off balance sheet for GAAP. And that was, again, not calculated. It wasn't intentional. It just turns out that a lot of the tools that I used to make sure that this was tax worthy also means it's off balance sheet for GAAP. Interestingly, too, again, another aha moment, it's also compliant with Sharia law because we're not lending. It's a services contract. So we're off balance sheet, we're Sharia law compliant, we're not diluting, we're tax efficient. There you have it. Some of the outcomes of unintended outcomes of intangible asset finance. You start solving problems, but those were neat moments to learn about the other attributes. I think this is going to be true for a lot of other types of financing strategies around these intangibles. Is that as folks solve for this, again, make a product that can attract capital that is also credit worthy or equity worthy. They're going to find some other unintended consequences that create value for all stakeholders that don't exist in traditional debt or equity investments.
Yeah. I mean, it's going to be a very interesting future because the assets just have totally different characteristics, right? In a lot of ways, some very big strengths. I mean, you don't have to pay maintenance, capex in the same way you would a piece of steel plant. So advantage, but also it could become obsolete, the next day. So a whole lot of risk and rewards, and financiers are good around a good structuring around risk and values, but they need to know what they are before that becomes useful. Any expectations around the future of intangibles financing?
It's got to evolve, right? Businesses are changing. The source of value is changing, and the capital markets have not kept up. They eventually will. I shouldn't say that. I don't know that they'll ever catch up, but new ideas will will be developed out of necessity and out of entrepreneurism that'll come that nobody'd ever heard of the Beagle structure before. Somebody had to do it first. Might as well be me. And I put intentionally. I've submitted a financial process patent around it to protect my IP with business. Be better if there were some other people doing it rather than just one person. But but I like to control the folks who are doing it. But that's an aside. And so the answer is I don't know where and when it will come from, but I do have high conviction that it will happen over time. Because businesses are going to need capital. Businesses are going to be different tomorrow than they do today. And traditional credit and debt strategies won't be sufficient to solve all the problems that business owners want solved.
Yeah.
Not the least of which is how do I grow my business and get capital I need without having to give up 90% of the value to somebody else.
Yeah. Yeah, well, we share your conviction, and that's the way the world has always been, right? Some entrepreneur somewhere has to take the risk, choose the timing, and have vision, and have the conviction to stick with that vision. So, yeah, well, we'll be looking forward to keeping in touch and seeing you succeed, and hopefully succeeding ourselves, and chatting again in 5 years about this forward-looking conversation.
I'm grateful for your support, your interest, your curiosity. The folks that dive into the things we're working on are generally folks that have a high degree of intellectual curiosity and like to see things, like to explore and understand things. I think you're going to do great things as well, and I'm grateful that you took the time to have this conversation, and humbled that you would think that some of the ideas and learnings I have would be of value to you.
Cool. Cool. All right. Well, thanks a lot, Matthew. We'll look forward to chatting again.
Cheers.